All right. Welcome, guys. I'm excited to be here. This is going to be part of our series of just really talking about how to bulletproof and recession proof your business, your mentality, and be able to protect the people you care about and really understand what's happening in this new economy. Because the more you understand, the more you get around people with experience that have an expertise that can give you a little bit of peace of mind and maybe a competitive advantage, the more successful you'll become. And no one really can know what's happening in the economy the next 6 to 24 months. But I don't know about you, but I want to be fully prepared to take advantage and to be 3-4 steps ahead of most people. So I'm excited about having my good friend, former pro skateboarder turned brewery owner turned real estate investor, and the current I love saying that, by the way, the current president of Community Capital speak to you guys. Currently, they're managing close to $200 million right now. And he's not just crushing it in that industry. He's super influential online, millions and millions of views on IG and TikTok. I think 1.4 million followers just on those two platforms. How we connected was our mutual friend, Randall Pitch. And I realized quickly, he's similar to me. He's ambitious. He's focused on adding value. He wants to change the game. He wants to level up. He wants to continue growing, but he's a family man, expecting his 4th kid soon, right? Is that right?
4 weeks out.
4 weeks out.
Pray for us, Big Doug.
Managing to provide for the family, spend time with his family while running multiple businesses, while creating amazing content. He's a big thinker, but practical. And from his pro skateboard days, he goes against the grain. And he's similar to me in terms of that aspect. We won't go too detailed, but he's going against the grain. He speaks the truth, does not fear people think about him. And the focus today, guys, is going to be investing in real estate in general. Mikey's predictions on the market based on his experience, his connections, and based on him having his pulse on the market. We're going to share some things that a lot of people don't know that might be a little scary, but they're reality. And we want to share that with you guys so you can be ahead of the game. And we're also going to share some insight into a current deal that's open, not for too much longer as well. So much appreciation, respect for you, man. Thank you for blessing us with your wisdom. Welcome.
Thank you, brother. I'm stoked to do this.
I'm excited. So I want to start with something simple. Okay. How does someone, and I want this to be super tactical. I don't want to do too much backstory, but how does someone that's a pro skateboarder get into investing and this deep, not just into investing, but this deep into real estate where now you're managing 200 million? How does that happen?
Okay. So one, it happened because I was fearful of what my life was going to look like after skateboarding. And I knew my window was short. So I had to figure out what to do. That fear kind of started the excitement to want to learn about investing. What ultimately got me to this point is 20 years later. So it wasn't overnight. And basically, and this applies to all of us, when you learn what you're good at, you can really take that skill and apply it to other categories, as long as you understand how to bring a team together to be able to capture it. My skill set, I am not an accountant. I am not an operator. What I am good at is I have good ideas and I understand how to bring people together before we build something, get their energy forward and get us moving when it's not really an easy time to do so. And then when you understand how your skill set applies to the team, then you're able to do things. Investing in real estate was very similar in a sense to our last business, which was St. Archer. It was a craft brewery. We had an idea. We had no money to do it. So we had to go raise money from investors to come into our plan. We had to implement that plan and then get it out to the market. And then ultimately we got to an exit. Real estate works the same way. Real estate works like small business does. So it started with me understanding what I was good at, what I wasn't, and then surrounding myself with great people, which all of us can do.
I remember a conversation we had in your skate garage. I don't know. You remember where was that? I don't remember even.
It was a warehouse that we put a skate park in for us to practice, a private warehouse.
And then Mikey's getting older. I'm like, you can't still skate. And then he starts.
I could barely skate.
Yeah, but you did a good job. But anyways, we talked about how one of the reasons you got into real estate was a lot of people not respecting the career when it ended and thinking the money was always going to be there. And there was a lot of athletes in your vicinity and people that you cared about that you saw struggle and that you saw not invest their money the right way. So isn't that part of the reason you kind of went all in and wanted to help other, not just pro skateboarders, but athletes in general? This is a big deal.
That would probably be the reason why I started the company. And originally I had the lens on skaters, but this problem goes well beyond skaters. It's like for any of us who are trying to take control away from either our sponsors, our employers, getting time back, that's done when we get our money to work, which ultimately frees up our time. Real estate just became, I would say, one of the vehicles that I had the most trust in. So when you looked at my total portfolio, that was the largest chunk. But I wanted to basically get this message out there to everyone who's struggling with this idea of, I'm making money, I know how to make money, but if I take my foot off the gas, the money goes away. And how to get that mindset to understand passive investing so that money could come in without doing so that we could get to a point where we have the choice. We have the choice to continue working or not. That's athletes. That's people in sales. A lot of people in sales struggle with that, right? Their year starts over the next year and they're back to work. And typically we spend what we make. And so they're never in a position to be able to step away. So it's ultimately creating this message of understand how money moves and how to put ourselves in a position where we can ultimately step away.
So educating yourself at the beginning, walk us through that process on how you got over imposter syndrome, or what's this skateboarder going to teach me about real estate, as that was the image of a lot of people. How did you get over that?
Yeah, it was brutal. I'm not gonna lie, it was brutal. So when we started the brewery, I wasn't out there on my social media telling you how to brew beer, right? I was just marketing the brand we were building. When I started this company, I was all of a sudden out here telling you how money worked, right? So the pushback was intense. I mean, it was probably 2.5, 3 years of my community telling me to shut up, all I did was focus on the mission. And you know what? One thing Gary Vee said actually that stuck with me, and I just kept telling myself over and over. Somebody asked him the same thing. How did you go from, working at your dad's wine company into VaynerMedia? And how did you deal with people telling you could never do this? And he basically said, look, I was the wine guy until I wasn't. So if you're willing to just do it for long enough, you'll get to a point where people won't even remember that anymore. And I'm experiencing that now. It's been 6 years. And I still have a lot of people from the skate community that follow me now, but I have a ton of followers that don't even know I was ever a skater, So you just got to focus on the end goal and not pay attention to the steps you're making to get there.
It's good for people to hear that too, because a lot of people don't want to put out content. They're like, I feel weird. I don't want to be seen as this. I feel stressed out. And they're always like, I, and it's really not about them. So it wasn't really even about you being an expert. It was about your mission, helping people, giving back and helping them manage their money and making their money work for them. Because you knew, even if they were in a sense, not understanding your mission, you still had compassion to help them. And there's probably people that did hate on you that now follow you and respect you and take your stuff and actually execute it, which is funny.
So that is my favorite message to get. I'll get messages from somebody and go, hey dude, 2 years ago, I heard you talking and I was like, this is the corniest shit ever. Unfollowed you. I couldn't stand what you were doing. And then 2 years later, it just popped up and I just listened. And all of a sudden I was like, holy crap. I started watching more and I started watching more. And now my notifications are on. So like when that happens, it's sick. But this actually applies beyond investing. This is just a life principle. If we live our lives trying to be accepted by the people around us, we will forever be miserable. We will never truly be happy, and no one will ever like us for who we actually are. Even though I had 3 years of what I perceived as the gnarliest pushback or hate I've ever gotten, it was actually the most enjoyable my life had been up to that point. Because for me, I stopped operating in the sense of what do I want? And I tried to actually make what I was doing a give back. And then, dude, my life was blessed just from a enjoyment standpoint.
They say too, people are going to judge you regardless. You might as well be who you want to be. Right. You might as well be yourself.
Right. Exactly right.
So let's bridge the gap. A lot of people hear about real estate. they get excited about real estate, but a lot of people just don't make the jump. There's too much unknown. There's too much fear and uncertainty. I say this, I don't want people to wait until their back's against the wall. Real estate investing is one of the best investments on planet Earth for a million reasons. My parents brought me up and told me every day, like, real estate is such a solid investment. Obviously, there's different levels, different types. Can you bridge the gap to someone that's a little bit newer and they eventually want to start investing, learn more about real estate, get into your big deals? How can we bridge the gap to share with people that you need to respect real estate, and not just respect it, but start educating yourself and get involved?
Yeah. So let's start with this. You first have to understand the two types of investors, right? There's active investor and passive investor. Active investor means you're doing all the work. You're finding the deal, you're managing the property. It is your job, or your second job for the interim. Passive investor means you're investing in real estate and other people are operating it, and you're truly making passive income, right? You need to pick one. And there's no right or wrong. It really depends on what you want to do. But when we're looking at how we get our money to work, and I think we're experiencing this right now in the stock market with crypto, that there's cycles and different investments have different risks. And when we're looking at a total portfolio, especially as we get older, we shouldn't be taking the same type of risk we were making in our 20s, right? Because we have more responsibility. I'm in a position where I'm about to have my fourth kid, and I can't just take the whole portfolio and roll the dice on red. It's too crazy. But you do want to do that at different levels based on your risk tolerance, but with a small percentage. And so how I looked at it, real estate was my safer investment. My riskier investment was me building my business, which was probably the highest potential for me to make money. And then a very small amount I would put into startups. I would include crypto into that. Anything that was really high risk, where I had a higher chance of losing my money, but potential for greater return, I had a small percentage of money going there. But real estate was that one that I could count on being there over time. You just have to start switching your mindset to have a long-term viewpoint of investing, which is very counterculture to what we're taught today, right? We want everything now. We don't want to wait till we're 40 or 50. We want to be rich by 22. And so something like real estate, especially commercial real estate, when you look at the returns, most people younger go, those returns are weak. Why would I do that? What we're going to experience, we're kind of starting to touch now, is when things correct, and real estate is it can do this, but it doesn't do it like how the stock market does. You start viewing investments differently, and you start wanting to put money into investments that you're not as concerned will go away in these volatile moments.
So let's talk about passive and active. Is the passive more for people that are a little more established and they want to kind of just sit back, or is it opposite?
No, the active is more based on what you want to do with your time, truthfully, right? Like if I'm an active investor now, I wasn't always. When I was skating, I was a passive investor. My outlook back then was skateboarding is, one, my passion, two, my greatest source or potential for income. So I wanted all my energy put towards the thing that could pay me more. Then I wanted to take that earned income and put it into real estate. So that was passive. If I was active, I would have had to been a pro skateboarder, and I would have had to hunt deals, secure financing, manage the property, or manage a property manager. That would have been another job, which I thought took away time from skateboarding, which compressed, or better way to say it, would make it harder for me to earn the amount I thought I could. I would dilute my energy. Some people just want to be real estate investors. So if you want to be a real estate investor, yeah, that might be a good start for you to be an active investor. There's no right or wrong. You do have the argument on potential return though, right? So let's take a deal I do and a deal that you're doing. And let's say the deal is the same, right? You will make more money doing your deal because you don't have to pay me to operate or find or manage that property, right? But what we see time and time again is people will bring us a deal and go, what do you think? Is this a good investment? And the deal that they have that they're going to do actively pays them a potential smaller return than the deal that we're doing that they can invest passively. If that's the case, do not do that deal, because you're now sacrificing time for a smaller return, right? The only time you want to do your own deal, if you're just looking at return, is if the return is significantly more, then that's a potential for doing it yourself.
I look at it too, and I wanted to ask that I kind of want to play the devil's advocate of me knowing nothing. It kind of has to do with priorities, your values, what stage you're at, because I was very, very passive. My first 25 or 30 investments was like, I don't want to do nothing. I
Right.
want turnkey. I want this and this and this. And then you start getting into active when you kind of put the other business either on autopilot or you have more time and you have more leverage. So it just depends on what stage you're at as well. So in terms of types of investments, there is so many different types people hear about. I mean, there's mobile homes, there's single, there's commercial, there's residential, there's duplexes, there's storage units, there's apartment complexes, all kinds. What are some of your favorites and why? Because what I want to do is create a kind of a tailored plan for people based on their income, but also based on their ambition level, based on how much time they have in capital, and give them different avenues to research. Because we're not going to talk for 10 hours and go through every single detail. But if you guys have enough clarity of what's to come, what options you have, and then what's to come in the future and how to prepare, you guys can do your own due diligence, which is you guys are action takers. So I have no doubt that you guys will do your own research, but share your thoughts on, because I know you love storage units, you've done mobile homes, you've done single family.
So my two that are my favorites, and it's also the two assets that we focus on with our business, and that's storage and multifamily. Now, that doesn't mean other assets are bad. The problem you have in real estate, now this is more on the active side, is there's a lot of ways to make money in real estate. And so a lot of people get in, they start educating themselves, and they see, what's hot at the moment. Oh, multifamily is hot. Now mobile homes are super hot. Now short-term rentals are hot. And you go around chasing the shiny object and you end up not becoming a master at any of them. It's actually a big challenge. So what I would recommend doing, find the asset class that fits your goals and focus in on that, and don't look at anything else for 10 years. Just super, super niche down. And that's what we've done. Why I like storage and multifamily is the two drivers. My lens is primarily based through, or let me say it a different way. I experienced the 2007, 2008 crash. It was terrifying, right? When I went through it, I had at that time what I thought was a lot of money, and everyone around me was in panic mode. Everyone around me was losing money, right? And I had somebody helping me at that time too. I called him 2000, right when it started getting dark. I was like, dude, how much have we lost? I need to sell everything. I don't want to lose more, right? He was the one that really educated me in this moment. He was like, dude, not only are you not selling, we're going to buy stuff, right? And I was young, dude. I was 4 at this point.
That's a perspective shift, though. The exact opposite of what you thought.
This is what everyone needs to know, right? On paper, it sounds easy. Oh yeah, wait for the market crash to buy. What they don't tell you is that it's terrifying. It is so freaking scary. You're watching everyone around you in pain and terror. It's hard to act in those moments, right? I had him go, no, dude, we're buying. And I went, there was a moment where I was like, you know what? Holy crap. I'm going to trust you, but I do not like this. And then we go on freaking buying spree, right? My experience was so much different after that than everyone around me. And then that forever changed my perspective from that point on. But what I will say is you never forget about corrections. When we started St. Archer, we started it in 2012. When we were out pitching in 2011 to raise money, one of the biggest pitches we had was beer is recession resilient. People drink beer during recessions because even in 2012, people still had the recession on their mind and they were still scared, right? This is 4 years later. So when I invest in things with the majority of my capital, I want to invest in things that do well during downturns. When you start getting into some of the asset classes in real estate, asset classes perform differently. Hospitality does not move the same way multifamily or storage does. Hospitality is impacted big. I don't know how Airbnbs or short-term rentals are going to do yet because Airbnb came after the last one. My expectation is they're probably going to follow hospitality. They're going to get hit pretty hard. Storage does well during recessions. They call it the most recession resilient asset class in real estate. I like that. Why is that? Look, us as people, we don't like getting rid of stuff, right? That's one. Two, when recessions happen, think of what happens, right? Like we're having short-term disruption, or we're potentially having to downsize, right? When you downsize, you're typically not getting rid of your stuff because you're looking at it as this is for the short term, and you want to place your stuff, in storage units during that downtime, and then you'll pull them out. Storage does well because of that. Multifamily or residential, people will always need a place to live. And if you start looking at the analytics of the amount of number of residential units that we've built over the last, let's call it 12 years, it's really, really bad, right? Like what we built leading up to the financial crisis from 2001 to 2007, we were freaking firing. And then, 10 years following, we're not even coming close to 50% of build of new residential. So we're undersupplied in a lot of areas. So I like being invested in assets that there's a need for, and multifamily did well or does well during downturns as well.
So really you're investing for good times and bad times to make sure things are recession proof, and focusing on human behavior in a sense.
Yeah, that's actually a good thing to point out. When you're investing in real estate, you're not asking yourself if there's going to be a recession, you're asking yourself when. Right? Yep. We know that they're going to happen. So when we underwriting a deal means that we're building out the financial projections. We are considering something happening in that moment, and we're doing what we call a stress test. We're stress testing the deal in case all of these things happen that are bad, to ultimately see if we still have an investment that can survive that abuse. And if we do, then we typically move forward on a deal. If we don't, we pass. So for example, we can go over this on when we talk specifically in the deal. If a deal only works if we hold it for 5 years, but doesn't work if we can't hold it for 10, we're not moving forward on the project. We have to be in a position where things can go wrong and we can still have a successful investment.
Love it. I'm writing this down. So in terms of, and it was funny, I was talking to Blake earlier about Airbnbs, and I asked him the same thing. Right. And luxury was hit pretty hard too. No one's like, oh, there's a recession, let's go buy a penthouse. You know what I mean?
Right.
So in terms of thinking about different things to invest in, you have to realize that the averages, the stats. So what he said too is there won't be as many bookings, but even 5 days a month, you might make your money back. So knowing all the numbers in your investments is key too. You might not make as big a profit.
Right. And what I would say too, because a lot of people are looking at Airbnbs as their first real estate investment. What I think 90% of the people are doing wrong, and is gonna hurt them pretty bad, is when they're underwriting their deals, they're underwriting them with the premium that you're able to get on a short-term rental, right? Short-term rentals do bring in more income than long-term. And so when they're looking at their expenses and their debt service, they're only able to cover those with that premium of rent, right? How I would underwrite everyone's Airbnb, if that's the way they're going to go, underwrite them considering that there's a downturn and you're going to have to put somebody in as a long-term renter, which is going to be less revenue. And if less revenue comes in and you can still pay your expenses and your debt service, then put it on Airbnb and make the premium now. And now you have a fallback in case something happens. But if the deal only works bringing in that much income, I'm telling you, it's going to be bad if that turns.
So let's talk about predictions in a sense. Is 2007 and 8 going to happen again soon?
That's a hard one. Look, is there a potential for it happening? Yes. Is there a potential for it not? Yes. That's the hard part, right? I'll say this: when we're underwriting a deal, we're looking at what if we're in a 2008 scenario again. Now, the difference is the demand for real estate right now is very different than the demand in 2008, right? We had demand in 2008 because we were giving loans that we shouldn't have been giving. Mm-hmm. So you now had all these new people that were able to buy homes that shouldn't have qualified. That was the increase of demand. Right now, the increase for demand is not because of lending. It's because of supply. It's like what we talked about earlier. We did not build enough. So there's a lot of areas where, like in our city, our city and neighboring cities are looking at being fined from the state because they haven't been building up to the state requirements. That in itself should put us in a position where we don't look like 2008. But look, there's a lot of crazy things going on right now. Could we get in a bad scenario? We could. I mean, shit, anything's possible at this point. It's just really hard to say.
So how can people prepare in terms of, let's create some action steps for them or powerful questions to ask, maybe for their first investment, maybe playing based on your experience, what you're seeing. They come to you and they're like, I have this much to invest. What should I do? Should I hold and wait for things to kind of settle down? Because what happens if the GDP is negative for the second quarter? We all know, then they make the announcement and it's a self-fulfilling prophecy of fear. Right. Even if things stay similar, the majority has a way of fulfilling their own need of fear and making it worse, right? If the news says there's a recession. So how can people best prepare right now? Besides kind of studying and looking at the market, is there anything they can do to kind of bulletproof themselves in a sense?
Yeah, that's a good question.
No, I'm asking you tough questions.
Yeah, that's a really good question. So there's going to be some factors that it's going to depend on what you're doing, right? Is everyone here an entrepreneur, or do we have some employees? Who you work for? Are you in an industry that, you think could get hit harder than others, or are you at risk of losing your job, right? So look at that one. If you're an entrepreneur, are you in an industry that is going to struggle, or is there an opportunity to succeed? I think for most entrepreneurs that haven't been through a recession yet, it's freaking hard, right? It really, really is hard. So I would say for entrepreneurs, you're going to have to make some tough calls, and you're going to need to make them fast, right? What happens a lot of times is people wait too long, and then they get put in a position where they don't have any more options. So unfortunately, you might have to make some hard calls soon. As far as your spending goes, right? If you're spending everything you make right now and you're not saving a certain percentage and investing a certain percentage, you need to figure that out now, because you will not have the opportunity to participate when things get bad, because you don't have the cash available for that time. So you need to start building the discipline where you're having an automatic withdrawal from every freaking check you make that puts a percentage in your savings, and then a percentage goes to investing. Other than that, surround yourself with at least 2 people that have been through a crash before. You're going to need a buddy system that's going to, kind of in a sense, talk you off the wall, because your emotions are going to get the best of you. Look, I am somebody who is emotionally sound. I very, very rarely get charged up. I'm pretty black and white. 2008, even I was panicking. So make sure you've got good guidance around you, because it's going to get scary. Here's the good part. When everyone is scared, that's when the opportunity is. It is absolutely true. But you have to get comfortable going against the grain, and you're going to have a lot of friends and family members look at you and go, "You're crazy. What are you doing?" Right? So just prepare for that.
Yeah. And by the way, any questions you guys have, get those ready. You can post those and he'll answer those as well. And I want to prepare you guys too, because people hear like, when most are in fear, be greedy, and vice versa. But it really is. If you look at all the companies started in recessions, if you look at what successful people do, the money always goes back to the people that understand supply and demand, understand market cycles and crashes.
Okay, so I'm gonna say something just on that, because I think it's really interesting. Something we're seeing. So you have retail investors, you have all of us, right? We're retail investors, and then you have your institutional investors. These are your big firms, big hedge funds, right? The way they're investing right now is very different than how we're investing, right? This group is already becoming fearful. Wait, what's going on? Pull back. This group, they are investing. Oh my gosh, it's crazy, right? And the real reason is most of us are looking at what's happening right now, right? We're stuck in this moment. These people, they do not care about a year from now. They don't care about 5 years from now. It is 10-year plus outlook, right? It's really important, at least in my perspective, to study what we call it the smart money. Study what the smart money is doing, because their outlook typically puts themselves in a position, like you just mentioned, where they're making all the money and we're out here losing it.
This is why it's important, guys, to really, really start educating yourself, getting on more of these calls, connecting with people like Mikey, and really kind of lowering the time where you're escaping reality, where you're watching Netflix series, because you have to educate yourself for your family. I want to dive into a not exciting topic, but a topic that's very important that people need to understand. I made a lot of offers, and I've been trying to buy houses in different areas for the, I mean, I'm always doing it. But the last 3 years have been interesting. Me and Caleb have made offers 80K above asking price. We've had all these things. I've had friends, they get 15 offers above their asking price for their house, full cash. People still don't get it. And then some company comes in and bam, they buy it for some crazy price. And as we're finding out, those houses will never be on the market. People know about BlackRock. If you don't know about BlackRock, it's something that you should probably educate yourself on. And I think they're in association with Vanguard, and some of these big companies want all of the real estate. So can you share? And it's odd what's happening, but it makes sense. And it makes sense because of how greedy certain big corporations are. So talk about some things you're seeing behind the scenes of the moves they're making and what's happening, because it's a little scary.
Okay, I just had this conversation earlier because I saw a TikTok video, somebody basically saying, Goldman just bought, I can't remember what it was, 187 million bucks of single family just recently. So I'm going to hedge by saying this. There's two trains of thought. There's one train of thought that looks at the institutional investors and goes, okay, they're trying to hedge against inflation and they're trying to have an alternative for bonds right now. And so what they're doing as the alternative is buying single family residence. And, they're buying them now, but typically they're only going to hold them for a short term, right? Usually institutional investors find out what is possible now, and then they reassess. There's that one train of thought. The other train of thought is that institutional investors are strategically trying to buy all of the single family residents to ultimately make it so that we cannot own. We become a true renters society. And that, by the time we get into, 2030, we won't own anything. They'll own all the control and they'll have a cash flow system, knowing that the majority of people's wealth is built in single family residence, right? Depending on what side of the aisle you stand on, is going to change your outlook of what's to come over the next 10 or 15 years. What we do know is BlackRock is buying a shit ton of single family residents. You saw Goldman doing it a couple days ago. You've got these huge hedge funds that historically have not bought single family residents. What are they doing?
Vanguard, I'm looking up some. Vanguard has almost 8 trillion in assets under management. They're right under BlackRock.
Really what this comes to, it's like you have BlackRock, Vanguard, and State Street. Those are the three monsters, right? And you kind of tie them with what you hear from the World Economic Forum and their agenda, right? And ultimately you have these guys talking about, in 2030, you'll own nothing and love it. And they go through their really kind of dystopian outlook of society, et cetera. And so that's really where this comes from. You see what they're talking about, and then you see the moves these groups are making, and people are going, this shit is, they're working together, right? Then you have others that go, no, there's a reason why these institutional investors are buying the way they do. In 2008, and this is what they would say, right? In 2008, 2007, 2008, there was such a discount on single family homes. They came down so much that it was worth it for these big hedge funds to buy all of these properties. The managerial or operational nightmare was worth it because the price was such a discount, right? Now you fast forward to 2021 and you're like, okay, there's no discount. Why are they doing this?
They're actually inflated.
Right?
The prices are 30 times higher, 30.
Correct. So now what somebody would say is, well, they figured out, they created the operating system in 2008. They know how to buy and operate these things now. So now they're playing against inflation, right? And everybody's yield starved. Everybody's chasing yield. So this is where they can do it right now. You have the others that are like, these guys are after us.
But you're seeing the latter, where you're seeing the moves they're making and how much they're buying. And based on the stats, these houses that they're buying will never be on the market ever again.
Yeah, so this is it's I'm going to say what I think, and I'm going to say where the differential view is. I think most of these companies that are buying these assets, I don't think they're selling them individually. I don't think they're putting them back on the market. I think when they buy these things, they're most likely going to sell them as a portfolio, which means they're going to sell them to another hedge fund, which means these homes are never coming online for private ownership, right? There's other people will say, well, it depends how they buy them. Depends what their hold strategy is. If they're, buying them in bulk, then yeah, maybe they sell them in bulk. But if they're buying them individually, there's nothing that stops them from pulling them off their books individually. I don't think they're going to do that, but there are a lot of people that do think that. So
the key here really is, and I'm on the latter as well, just from all the studying I've done, they definitely want to take a lot of these homes off the market, and they're making it impossible for a lot of everyday average people who don't know these things to buy anything. Right. A lot of people couldn't even buy a house because of the 15, 20 offers over the asking price. So
Peter, hang on one sec. We'll pick on one sec, because I do want to say this though, because I think this is important. There's a lot of people that are looking at these big groups that are going, dude, they're buying so much. That's the reason why I can't buy a home, right? As of right now, as of this moment, that is not the reason why we're not able to buy homes for now. The reason we can't buy homes is because it costs so freaking much to build them, and it's so hard to build them that we're not able to catch the demand. And so whenever you have supply low and demand high, the prices are going to keep running, right? And now you have this inflationary moment, but that's hitting construction really bad. When construction costs come down and we're able to build, you should see that price come down. But if these big funds are going to continue to buying at increased rates and they are really trying to hold forever, that's where it could get scary.
For sure. So I say too, let's not talk real estate. Let's talk entrepreneurship. Let's talk mindset. Let's talk bulletproofing yourself. Let's talk skills. What are some things people need to sharpen your skills, start educating yourself at a higher level? You better elevate your circle. You can't be I'm telling you, when the recession, if it comes, or when it has been in the past, people I've talked to, if you're around other people that are in fear, they will put that fear in you because it'll make them feel better about being in fear. So you got to find, like you said, the buddy system of people that have been through recession and know how to navigate. Next thing is learn how to become more valuable, which means when you become more valuable and you know how to build raving fans, you know how to educate people, you know how to network and connect, right, and build genuine relationships, you can print money in a sense. Right. It sounds funny, but John Lennon used to say, my wife needs a swimming pool. I'm going to write another swimming pool, which means he's going to write a song that pays for the swimming pool because he knows his skill set. So it's like, you need to figure out what your unique advantage is and make sure you're ready to capitalize. So I love that. Let's go through some questions. Brandon had a really good question I saw. Are you selling or liquidating anything to be prepared for the uncertainty of the next 12 months? What percentage of your portfolio do you have in cash to deploy when the time is right?
That's a really good question. So are you selling or liquidating anything to be prepared for the uncertainty? No, we're not selling to prepare for the uncertainty. We do have one project that we are listing, but we're only listing it because we think we can get a price that would show our potential highest IRR for our investor, where if we hold it beyond that, the IRR is just going to go down. So we're looking at it more as, if we can get that price, we'll sell it. If we can't, we're not selling it, we're holding it. And I'm going to answer the second part because it's a really good question, but how we look at, let's say, apartment buildings, what we're really asking ourselves is, will there be demand for this apartment 10 years from now? And will I get the rents or the cash flow I need for that project? If the answer is yes, then we're not so concerned with what happens in the interim, because if interest rates go freaking nuts on us and cap rates follow, which means the price of our real estate is going to go down, there's nothing that's going to force us to sell. Now, how much cash are we sitting on in our portfolio right now? In our storage portfolio, oh gosh, don't quote me on this number, but I think we have about 15 million of cash right now in our portfolio. And and we're looking for deals, but we're not waiting for the market to crash to strike. We're looking for deals right now. We're just looking at 40 or 50 deals to put one offer in to most likely not even get that offer. So it takes a lot of work in these moments, but we have the mindset of we want to be investing always. It's just a different type of discipline based on the time you're in. When everything's good, everything in you is saying, let's go. And you're having to really stick to your buy discipline. And then when times are bad, you're like, give me these deals. And it becomes harder to raise money from capital. It sometimes could potentially be harder to get debt, et cetera. So
when Kendra has a good question. When you're analyzing, thanks for answering that. That was a great answer. Great question, Brandon. When you're analyzing properties to invest in, it's great to have both cash flow and appreciation. Is there one that you value more than the other? If so, why? Another good question.
Really good question. What is this group? This is a good group you got.
These are the sharp ones.
So it depends on actually the investor's goal and what they're looking for, because typically you're going to try to find an investment that fits, your intentions. What we typically see is when you're younger, you're looking for the wealth build. You're trying to get your money up, and that's typically going to come from appreciation. As you get older, you typically start shifting into wanting more cash flow. Now, how it usually works is if it's appreciation, you have a higher potential for return. If it's cash flow, it's typically a little bit lower. But even though our projects are typically big value add projects, right? Like I didn't go over this, but what we really look for is a vacant or dead or distressed asset that we can repurpose into storage or multifamily. So that means we're doing the heavy lifting. There's appreciation in what we're doing, but you need the property to cash flow, right? Cash flow is the lifeblood to your asset. So I would say they go hand in hand. If you're just trying to, turn and burn these things and flip them, yeah, you're not looking at necessarily cash flow, but that's not how we invest. We're ultimately trying to build to the cap rate we want, not what the market has to offer. Did that make sense?
Great question, Kendra. So in terms of, there's one more, we can answer that too. In terms of, I want to talk about standards real quick, Mikey. In terms of standards for investments, they're probably similar, whether it is mobile homes, single family, multifamily storage units. What are some of the non-negotiables that your whole team, company, you have when looking for investments? Because you said something very important. You said, we're not sitting here waiting for the market to crash. And another thing I want to share with you guys is every piece of real estate that I have really ever sold, I look back and it's gone up. Real estate always eventually goes up. So I regret really selling. I you know what I mean? So, and I see that now looking back, hindsight. So you're not selling anything. You're just continuing as planned, but you're moving a little differently based off the predictions. That's kind of what I'm hearing.
Kind of. We sold 2 assets last year. We will sell if the price is very attractive. But we are in a little bit different of a game than if you were investing just yourself, right? Sure. Because when we're selling an investment, because that's kind of what we're doing, we're selling a projected return, and we're really trying to hit that return for investors. If we never sell the project, we start getting into a scenario where we're never going to hit that return, because when we pitch something, we're pitching IRR, which basically means that your return is your total return, right? So from all cash flow and appreciation is calculated over time. And so we're keeping that kind of, we have to maintain that because we're trying to honor what we're trying to return for our investors. If you're not, then you get in a scenario where you're just like, let me just buy everything and own it forever. The question though, there was a question, non-negotiables. One thing that's a non-negotiable for our company is if we don't want to own the asset for 10 years, we don't want to own it for a day. That's just us. So a lot of times, we look at, let me say this, actually, this is important. When you're underwriting a deal, you can make a deal work. You can kind of financially engineer a deal to work on paper, and you can also beat it to death so that it doesn't, right? A lot of people, we kind of have a tendency to make the deal work. And so we expect all of these things to happen for us to hit our return. You have to know that nothing goes according to plan. And usually all the things you want to happen don't. And so don't base your investment off of, I need these to work for me to make money, because they're not all going to work and then you're not going to make money. It's really important to be conservative in your underwriting.
And different investments have different standards too. This is not a fix and flip call.
Right. Right. Right.
Does Mikey know about that? Yes. Does he focus on them? No. Like he said, if you focus on fix and flip and storage units and mobile homes and single family and luxurious and Airbnb, you're going to be confused and you're probably going to miss a lot of money in between, and you're not going to be known as an expert. You'll be known as a know-it-all, or someone that is okay at everything.
And I'll say this too, our first storage investment was in 1998. We didn't start building our multifamily portfolio till like 17, 18.
Wow.
So it like, seriously, hyper focus. It'll take you so much further. It's hard to do though. We want to do it all.
Should we be taking on more debt right now, or should you look for private equity instead with your investors, or both?
So how we are as a company, we raise money from investors. So they come in as the equity, and then we also finance deals as well. So that's the debt. Should you be using debt or not? Some people say yes, some people say no. We're believers in debt. We just know that it's powerful to make you money. It's also powerful to take from you. So we try not to over leverage in our deals. And because we own multiple assets, we're trying to be mindful that all of our loans don't come up at one time, right? You try to stagger your maturities because we don't know what's going to happen in the future. And if it's not a great time to refinance, we don't want all of our properties getting hit at that time.
So based on your experience and your mind and your network and your predictions of inflation, of the rates in the next 6 to 12 months, would you lean towards debt, or would you say maybe hold off based on what's happening?
Well, it depends what debt you're talking about, right? Like if you're talking about long-term financing, my perspective is like, oh yeah, why not? Considering I need to hedge. It's a good deal. You're not over leveraged, right? Why not put long-term debt on it, right? Like interest rates go up, great. You have long-term fixed debt. If interest rates go down, is there an option for you to refinance? Do that then, right? Where people get concerned is, are you using short-term debt? And what is your expectation on the long-term debt, or what are the interest rates going to be when you need to go into permanent debt? That's probably what you need to be mindful of right now, because what our expectations are, interest rates are going to continue to rise. And so, you don't want to underwrite your deal that you're still going to lock in, 4% loan, and now it's 5.5%, and you didn't prepare for that.
It's really do your due diligence and think things through at the very highest level. Can you answer Vance's question? And then we're going to go on to this deal.
You mentioned stressing the calculations when you underwrite a deal. Are there certain consistent stress test levels you put on the pro forma? Yes, that's a really good question. And we'll go into it in depth when we're going to pull up a deal we're working on right now. But basically, some of the things we're looking at when we stress test is we build projects, or we repurpose them. So is our construction timeline going to go longer than planned, right? So our stress test would be, what if we have to add an extra 6 months to our construction? How does that impact our deal? What happened if construction costs go up? So we give ourselves a cushion. That would be our stress tested model. And using that extra capital, what does that do to the deal? We look at interest rates rising. We look at cap rates rising. We look at rent growth not growing at the same rate. We look at rents coming down, or occupancy not leasing up at the scheduled time that we're planning on leasing up. And what we do is every single one of those factors, we look at how that impacts the deal. And then we ultimately have a page where it's like, okay, all of it hits at once. 2008, do we still have a deal? And that's typically how we stress test them.
That's an amazing stress test too. I don't think a lot of companies, or obviously the biggest ones, understand, and you do, but that's a pretty good test. Just thinking about the recession, or if it happens.
I'll tell you what, we pitch a lot of investors, right? What we hear over and over and over is the stress tested page. That was, if they become an investor of us, they say that's the page that did it for us. And for the investors that don't, they all say the same thing. That was the best presentation. That stress test was huge. So I'm going to give my team credit because that was not me. That's important. It's really important, especially in times like this.
It mitigates the risk and it increases peace of mind.
Right.
Which is what investors want as well.
Right. Right.
So here's what we're going to do, guys. He's going to bring up an actual active deal that I've seen. That is one of the best ones I've seen from Mikey, and we've talked for years. And he's going to show you the actual numbers of the different timeline of when they're looking at selling, when your first return is, all these things based on certain calculations. And it's going to be exciting to see. If you guys are interested and you're an accredited investor, if not, you can talk to Mikey. But I wanted to present this opportunity because not only will it educate you on what to look for, it'll show you what good deals are. And I've seen hundreds of deals the last couple of years, the last 5-10 years. And there's certain things that I look for and certain things that I know are possibly red flags based on my investing style and based on where I want to be. And it's good for you guys to learn that. So we're going to stop the recording because by the time people watch this replay, this deal will probably be done. There's already been millions raised. And we're going to continue right afterwards. So Mikey's going to bring his partner. They're going to show you guys this deal.